Bitcoin hasn't seen a new all-time high in 83 days, but it's well within striking distance, now just 4% away from breaking that elusive $74,000. But how could this be happening? Why is it happening? Today's video, we're looking at some data that we haven't seen in the markets for over 15 years and what this means to the markets over the coming couple of years. Something that almost always happens next. Make sure you hit that like and subscribe button. You're joining me, Jason Pizzino, on the channel here looking at the macro data, covering Bitcoin, crypto, stocks, and of course, the real estate market. Thanks again for joining us here on the channel. There's about 30% of you that haven't subscribed yet, so do make sure you hit the subscribe button so that you are updated with the data. Today's agenda, we're looking at the macro cycle. We have real estate, the cycle to get through, real estate data, massive stuff here that is showing pretty significant signs of what is to come next, which then spills over into Bitcoin and cryptocurrencies, stock market data, and lots of it for 2024, looking at where these prices will go, which of course then also shows what Bitcoin and cryptos could potentially do from that. Stock market TA, Bitcoin and crypto. We've got BTC, the total cryptocurrency market cap, some altcoins to get through, and the crypto sentiment. So as you can see, this video is going to be jam-packed full of information. And now if you aren't following regularly, you will miss out on some of the critical data, especially when it comes to the macro cycle, as I can't possibly get through everything in every single video. So that's enough of my shilling about subscribing and following the videos with your bell notification icon. Let's dive in. Quick overview. 18.6-year cycle is how all of this has eventuated. It's how Bitcoin has come about from the collapse of 2008, with Bitcoin being born in 2009. Essentially, this cycle has played out throughout human history for our financial markets. Every 20 odd years, we see a mega boom and a mega bust. And that occurs through the stock markets and of course, real estate. But this is focused on real estate and the economy. And we are roughly leading into this final surge in prices. And I'll show you how that is playing out in the data now and how it has continued to play out. So we're roughly around here now. I just need to update this chart and move it a few pixels to the north in case you're wondering about the yellow circle. This is the winner's curse phase. The winner's curse is very similar to what happens in altcoins or penny stocks or stock markets towards the end of their cycle, where everyone seems to be a winner. And the curse is that you get overly excited and you think you are one of the greatest traders that have ever lived because you can't lose. That is what is going to happen in real estate, and it is coming up very soon. We've seen all of the signs over the last 12 years out of the real estate low of 2011, 2012. Remember, the stock market was 2009, and that comment comes up a lot, but this is where the real estate cycle has begun from. So in terms of the cycle for the stock market, this is what we are currently following here. We're looking at a trading range that is occurring with the stock market. We still don't see any sort of major collapse in 2024. Therefore, from what I can see with my own data and what I'm doing, I don't see there's any sign to be dumping out of my portfolio of stocks, if I have one, based on the cycle itself and the TA that we'll get to in just a moment. It seems like we're going through a trading range for the S&P in this election year. And what typically happens over the last 7 months of the year is further upside. So this is showing if there was a top in Q1 in election years, typically the next 7 months are up. Yes, there are going to be corrections. People are going to freak the hell out, as they always do. But overall, when you look at it from an open to a close point, if you shut your eyes for 7 months, it suggests, the data that is, suggests that you'll see higher prices for the stock markets. Now, how is this all occurring for the stock markets? This is our theory here for the stocks and for real estate. Where does some of this data come in? Well, interest rates are obviously high, so people are paying more on debt. Since the end of 2019, personal interest payments are up 197 billion. But what they don't always tell us is the interest, and the interest is higher than the payments. So someone's making money and that money is going somewhere. It might not feel like us that are making the money and that gap is getting wider between the haves and the have-nots. That is unfortunately what is happening at this stage of the cycle yet again. As we lead into these peaks, those gains for real estate typically become bigger and bigger, and that leaves the have-nots behind, which then eventually causes a collapse as well, as I'll get to in just a moment with some more data. But first, credit card debt is about 1.3 trillion, a new record. 1.3 trillion in credit card debt. We hear that a lot as well. But credit card debt as a percentage of disposable income, is the blue line, is 6.5%, and it's still below pre-COVID levels. So that's the COVID level, and it's still below those levels. That's something that they don't tell us about. They just tell us credit card debt is at a new record high. Well, no shit, Sherlock, it's at a new record high. But if you put it into perspective, it's still at a small percentage of disposable income. That's the important part here. So if you can still afford to pay the debt, just like the US has a massive debt, massive amounts of money needing to be printed to pay off the interest, but provided it is still getting paid off, then the Ponzi scheme, the bubble, whatever you want to call it, the manipulation, it continues on and potentially indefinitely from what we can see. And yes, I know there's a lot of people that believe it has to collapse this time round, but they all thought that in 2008. They all thought that in 2000. They all thought that in 1987. And for the majority of people, they've only been in financial markets for the last couple of years. They forget what's happened over the last 40 to 100 years. So let's have a look at how this can continue on. And this is direct from Freddie Mac's website here. Freddie Mac, one of the biggest banks in the US. And the data that has come through for their May report here is that they have a lot of equity in their real estate portfolios, and some of that equity may be able to get released. So if we just have a look at a couple of these numbers here, the first quarter net interest income was 4.8 billion, up 6% year over year. Now, the important part we're going to look at here is single family mortgage portfolio grew by 2%, and non-interest income for the first quarter was 1 billion. So income coming from not interest, an increase 672 million. You've got total mortgage portfolio at the end of this quarter is 3.5 trillion, 2% increase year over year. There is a lot of equity continuing to be built on real estate. How I hear it at the other end. How the hell can this happen? Things should collapse. Eventually they will, but there is more equity here that can be released onto the market, which means they are creating credit, which means they're creating money that goes into the system. And if we read a little further down, their loan to value ratio is still quite good. 52% for single family dwellings. So single family portfolios remain strong. That means that it's only leveraged at 1 to 2. Very low leverage when you compare it to what happened at the peak of the GFC, which was about 33 to 1, some of these banks, which was mental, absolutely mental leverage. And yes, a collapse happens, but you're probably not going to see a collapse when it's 1 to 2 in terms of the leverage. It's similar to Bitcoin and crypto. When you see that leverage get way out of whack, then the liquidations happen, it gets absolutely flushed out, and the cycle begins again. So we keep reading down a little bit further, and it basically goes on to say how healthy things are looking when it comes to the actual numbers. But the conclusion is the interesting part here with what they're going to do. In conclusion, Freddie Mac helped all these families get homes, etc. Importantly, most of the liquidity we provided supported low and moderate income households, as well as first-time buyers. Unfortunately, towards the end of the peaks, it's always the newbies into the game that get destroyed. So I'm hopefully providing you with the information not to get destroyed at the end of the cycle. Towards the ends of the cycle is where you start to get a little bit more defensive with your portfolios. Defensive just means to not go ridiculous with your leverage and start to throw more and more money into the system as you see things pick up. That's reverse pyramiding, basically putting more money in at the tops rather than the bottoms. As affordability challenges are expected to persist, so we know there's affordability challenges, efforts to expand affordability for homeowners and renters will remain a key focus of Freddie Mac. Essentially, they're going to try and make it easier for people to get money to buy properties in my opinion, at the worst possible time. What they won't do is make it easier for people to buy property at the lows. They're not going to make it easier to buy at the lows because everyone is scared at the bottoms. That's just the fear and greed. Whereas we're starting to see more and more greed pick up. Well, what do you think happens? Well, more and more people get into the market at the worst possible times. This is going to continue on. If they release this equity, then you're probably going to see more and more money into the markets. And when we look at Australia, there is definitely a lot more money into the markets. Essentially, we've seen another positive month here. 0.3% hit a new record high in May. This takes us to 16 months in a row of positive real estate prices in Australia overall. Now, yes, there are going to be some cities that have not seen that, Hobart and Canberra, but if you're watching from anywhere else around the world, chances are you've never even heard of these cities. Sorry to say, Canberra and Hobart. Hobart's actually a pretty nice place. I probably would never go to Canberra again, but no offense to anyone living in Canberra. Here, Brisbane, 18% above their December 2022 low. And Perth and Adelaide are also absolutely going mental as well. This is all part of the second half of the real estate cycle. And this is exactly how it continues on. This happens all around the world. We've seen it in Canada, we've seen it in the UK, we've seen it in the US. South Australia abolishes stamp duty, which is essentially a tax for buying property. For whatever reason, councils and governments just want to tax us for buying property. For all first home buyers, purchasing or building new homes. So it's purchasing existing or building new homes. So they're making it easier for new people to get into the markets by making it cheaper by taking that stamp duty off, which can be pretty hefty. If you're paying now the average sort of $800,000 and it's usually sort of like 2 or 3%, quick maths, you're looking at sort of 20 or 30 grand extra that they're allowing them to save, which eventually gets built into the price because now they can bid more to get that property. So they're really not saving anything. They're just bidding it on the price. And this happens all around the world, all the time, most importantly towards the end of the cycle. Interest rates, big topic as well. They are still sitting at 5.5% with no chance of it falling in the next, I think it's 7 days. Yep, 7 days to go for the interest rates. And then the following meeting in July, it looks like it's probably going to remain the same. This was the theory at the beginning of the year. I posted it on January on X, suggesting that we would not see any interest rate cuts for 2024. So far, that's been the exact case. And the first one is September. They're really swaying to get this cut happen in September before the election. So we have to wait and see whether that comes through and whether it just continues to pause at that particular area. But so far, interest rates have not been cut. Now, I did say I've got a lot of data to get through with the stock markets, but as this video is getting a little bit long, I'm going to leave this for the next video. So make sure you are subscribed on the channel. See if we can smash this thing up to 3,500 likes, help it out in the algorithm, share it with a friend. This is really, really interesting data here for the summer months in the stock market. I've also got more stuff on the US stock market, S&P, something on the NASDAQ as well for the top, well, so the first 100 days of the trading year, and then some bearish divergences showing up. But for now, let's have a look at the stock market here. US, 5,300 points. This would have been a new all-time high back on the 20th of March. So just short of 3 months ago, this would have been a new all-time high price. Now to the downside, the 50% levels are still intact. 5166 is the level there, and this is just of the small short-term range. And then the previous all-time high is 4,800 points. So still plenty of room to the downside if this one continues on. If we saw some trading ranges eventuate over this month and the next, see some move to the upside, move to the downside. That's what a trading range is before we get on with the move in the last half of the year. So coming back to the agenda, we've hit the macro cycle. We've got real estate cycle, the real estate data, the stock market data. I'm going to have to leave for another video just so that this doesn't get too long. If you do want to see longer videos, let me know on the channel, but I prefer to keep them to around 20 minutes, which I know this one will be a little over. We've got Bitcoin to come next along with cryptocurrencies. So let's hit that now. Bitcoin underneath the old all-time high. It's bounced off $67,000 relatively well here. We're on the Coinbase chart. And like we've been looking at now for nearly 3 months, as Bitcoin came into a top here based on our 3-day down signal, which suggested that the top that we would see this being the top for longer than most anticipated, because in March everyone was anticipating an $80,000 or $100,000 Bitcoin, which did not come. And this signal right here told us that we're probably going to range trade for a while, but there is still more in the move. It just needed time to cool off. 83 days underneath the old all-time high. We're back at $71,000. So these have been the levels that we've seen over the last 3 months play out relatively well. Every sort of $2,000, there's a bit of support and resistance. As it breaks through one, it gets a fake out, comes back down, tests 67. We broke through 69 over the last couple of days. Now back up around 71. Yesterday tested it, and we're on the case again today to attempt to break through that $71,000 level nice and cleanly. To the downside, the 50% still intact at 66,000, and the entire correction range is still intact as well. There's the $65,000 level. So everything's still looking relatively good for a wave 4 for Bitcoin. So basically this correction to be in and for the next leg to start, which does not mean that we're going to blow up in a matter of days or weeks, but I think we could still take a bit of time here. We got to, essentially Bitcoin's price has got to consolidate above $72,000 now. There's been multiple attempts over the last 3 months, like you can see back here in March. The 72 line is there, and it has barely closed. It hasn't even closed 2 days above $72,000, if I'm not mistaken. That was the only day that it closed above $72,000, which was the day before the old all-time high on the 13th. And since then, it has not closed above 72. So it needs a bit of work to do above 72. If you haven't heard me say that enough, mark it on your charts. Multiple closes above there is going to be much better case to take out the next old all-time high. More signs that Bitcoin and cryptos are winding up for another significant move come from the average true range. Now, I've looked at this in detail on the channel in the last couple of videos. So as a recap here, thanks to my brother Michael, which you can also follow and find his links in the video description for X and YouTube. We've seen one of the smallest days since January, says here. So Bitcoin did a $500 range day on the weekend, on Saturday, which then drops the range of the bars even further. And typically when this happens, you see some sort of wind up period, not necessarily the next day, obviously, but it takes a little bit of time there. And you can see at each of these occasions, you will see a pretty significant move to the upside. Now, it doesn't look like much here on the chart, but remember these prices were around 26 or 27,000, and it quickly shot up to 35. So a pretty good move in terms of percentages. Same thing happened again here around 35, and it shoots up to about 40 or 44, something like that. And then again happened here in January, shot up again. That was a big one. And it looks like it's winding up again here. So this goes back over the entire history of Bitcoin, all the way back to the early days, 10, 15 years ago. And you can see this happen across all markets as well. When you get this tight range wind up, typically you see it explode the other way. The same thing has happened here on the total cryptocurrency market cap. Prices have been consolidating for quite some time underneath the 50% level at 700 billion. This was my period here in April of the death of crypto, because the prices had died off, the interest had died off, the ranges had died off, but there were still higher lows forming on strong altcoins, which, as I said in the agenda, I also want to get to. But we're looking at the total cryptocurrency market cap to give us a broader view of the market. 700 billion is going to be the key level here for the altcoins to get above, and then 800 billion. Now, this one excludes Bitcoin and ETH, but includes the stablecoins. If you want to exclude the stablecoins, you can check out TIA Crypto total market cap. There's a link to this in the top of the video description for TIA indicators. That's where you'll find the indicators here, like the Gann swing indicator. Okay, looking at where we sit, again, it's the same sort of move. I see this as a stealth move for the altcoins, and the stronger ones are going to get the gains when this breaks out. So the theory here is we're in stealth, small ranges. The stealth is identified here with small average true ranges of the bars, and you want to find the strong altcoins which are putting in higher lows, like the total market cap is doing itself here. If your altcoin is putting in lower lows, that is a weak altcoin. It is not an opportunity to buy a falling knife and hope that it pumps to new all-time highs. You can do that. You could ignore it, hear what I'm saying, by all means. But the best thing to do is do your own research and look at charts that has happened on before for altcoins and see what happens next for them. They will get moves to the upside. I'm not saying they're not going to move, but what is going to move easier and stronger are things that already have momentum. It's easier to push a car that's already moving than to try and start pushing the car that is stationary. You know, it's the same old sayings that go throughout time. You want to find stuff that has proved the move, it's on the journey already, and then when it's ready to blow, it just takes off rather than trying to push shit up a hill. That's essentially what is happening when your coin is going down, especially against its BTC value. Now, this is the fractal from 2020, and as you can see here, it's doing relatively all right. It's putting in higher lows like it did in 2020. Then you get the breakout, and then you get another consolidation again. That's essentially what happened later in 2020. Now, altcoins. This is what we all came here for, I guess. Or maybe you do want to see more of the macro cycle stuff, the interesting stuff that actually allows these markets to continue to boom. Essentially, people are looking for risk on assets if the traditional markets are also in a good space. Here we are. How do I get there? We're at TON coin versus BTC, and it's putting in higher lows here. I did a post on X and also been talking about it on YouTube for a while now, referring to this date here. So for many altcoins that had already started to fall from March, whereas you can see here, TON coin had a top in April. That 13th of April low was a significant low. You can see here, this was the 13th of April low, and a lot of altcoins are putting in higher lows from that point. TON coin had its 13th of April low, a little bit of a lower low here, but remember it was pumping later than the other altcoins as well, which means you'd probably see it bottom a little bit later as it was still going up while the others were topping. Now we're seeing higher lows form here, and it's attempting to break the next 50% level. And that 50% level is a significant 50% level, which is the entire correction range from late 22 down to early 2024. So it's attempting to break out here, which could be a pretty good sign for TON. So some of those strong altcoins are going to see the same sort of chart pattern. Now, in terms of the meme coins, which had been doing very, very well over the last few weeks, some of these are now pulling back and potentially pulling back above their previous resistance zones, which will potentially become support. So keep a watch out for that. Provided they remain above their strong levels, their 50% levels, they could be good opportunities moving forward into this next stage when the altcoins start to break out of these levels. So hopefully you're able to put that together to understand where the strength lies, where the good entry opportunities are, and then what to look out for to the upside should that opportunity eventuate, or if you need to get out because there's an invalidation. I know a lot of you guys are getting it, especially the members here, TIA Premium, link in the top of the video description, hitting the runs on the board here, smashing it out. They are winning time and time again. So well done to you guys getting your gains in while the times are good. So that's a quick look at some of those altcoins and how to identify strong and weak. In terms of the sentiment, I'll keep it quick today and go into more detail in future videos. But essentially, we're still sitting around greed on the fear and greed index. And when we take a look back, the flush out was potentially just that day on the 1st of May, where Bitcoin dropped to 56K. And of course, this reading came through on the 2nd, going down to 43, which was fear on the fear and greed index. And since then, essentially, we have not seen any lower prices. So the theory that I have that this is one of the least feared bull markets of all time in cryptocurrency going back to 2018 is still intact here. So I hope you enjoyed that update, a look at the macro cycle, Bitcoin and cryptos, some of the data that is coming through for the first times in over 15 years, looking at how positive this real estate market is absolutely quite phenomenal. As I said, going back to the early days after that global financial crisis over 15 years ago, we're starting to see the same sorts of signals come through that happened back then. more money coming into the system. Government's doing the exact same thing as they have done forever, just allowing new home buyers to get into the market at the peaks, which then brings more money into the system, which then leads over to more riskier assets like Bitcoin and cryptocurrencies. Sorry to say, it is one of my loves as well, which then leads into an eventual bust. Plenty of time. I think there's still a boom to go with this everything bubble. Stay tuned to the channel, like and subscribe. I'll see you at the next one. Until then, take care and peace out.